why should I trust it? Why should I feel like I can put my money into it and get returns over time and not lose my money? Well, let me say this. If you do buy the stock of an individual company, you're taking on a lot of risk that is specific to that company. And there have been many cases where individuals did lose everything they had by having all of their money in one company. But let's talk about the stock market as a whole, right? Are the biggest companies in the world on a broad scale going to go away? Nope. Will some of them? Probably over time, definitely over time. If you look at 100 years ago, the top 50 companies in the stock market versus today, it's vastly, vastly different because things change. But all at once, at one time, nope, they're not going to go away. So think about this. Is Apple going away? Or Amazon? Or Facebook? Or Google? Or Johnson & Johnson? Or Walmart? Or AT&T? These companies are so intertwined into our lives. These companies have such a hold on what we do day to day that it is not super conceivable that one, they would go away at all, but two, that they would go away on a broad scale, thus making us lose all of our money all at once. Because if all of these companies did in fact go out of business, then our economy as we know it would change dramatically. We would not have the same kind of lives that we do today if those companies all just up and went away at the drop of a hat. That just is not a conceivable thing to occur, at least not in a rational sense. But that being said, big companies do fail, and we've seen it in the past. We've seen the Enrons, the WorldComs, the GMs, the Lehman Brothers, all of these different companies that were huge end up going bankrupt and no longer existing, or at least in the form that they were existing previously, or they had to get some type of government bailout in order to remain liquid and solvent. So big companies do fail, but the issue is not that one or two or three or four big companies fail. You notice that that was a relatively short list. And if you look at the list of big companies that have just outright failed and filed for bankruptcy over time, that list is not far too extensive. And the reason for that is because these companies have advantages that made them big in the first place. So let's also consider the fact that in these stock indexes like the S&P 500, the Dow Jones, things like that, they are rebalancing their portfolios every now and then to include companies that meet the criteria of the index and exclude companies that don't. This does happen. For instance, ExxonMobil got dropped from the Dow Jones recently, and that was a negative impact on their stock, but this happens more often than you would think. So what does this mean? This means that firms that will no longer meet the criteria of the index will fall out of the index and be replaced by companies that do. So there is this bias of these indexes, of the stock market as a whole, to where if you're buying these market indexes or these broadly diversified mutual funds, and they are getting rid of the firms that no longer meet the qualifications and they bring in more companies that do, then you would expect that your money would grow over time. Not every company is going to perform well, and not every company is going to go bankrupt either. Far from it. Most of the firms won't go bankrupt, or at least won't go bankrupt while they are in the index. They will fall out of the index before that even occurs. So other than the logical argument that will everything go bankrupt, let's talk about the returns of the S&P 500 over time, and why those have been historically very good and historically very consistent. So since January of 1871, that's almost 150 years ago, the S&P 500 has returned 9.125% annually with reinvested dividends, meaning that any money that the firm was going to give to the investors just reinvested it. They would have made a 9.125 annual return. That is outrageous. That is awesome. That is crazy for that much consistency over time. So then let's just look at the last 100 years. Well, the last 100 years, it's been 10.43% average annual return with dividends reinvested. And then let's look at an even shorter period of time. And the reason that we would look at this is to do some basic math as to how can you grow your own money and why you should trust the stock market itself. In the last 40 years, the market has made 11.39% average annual returns. And so let's say you just took $150 a month. Let's say you were, 25 years old in 1980 or 20 years old in 1980, and you just took $150 a month and you invested it in the S&P 500, and you did that until 2020. You did that until the end of last month, because that's when we have the data through. So you did it through the end of last month. Then your money that you were just putting in $150 a month, which is not a lot, that would have been over $1.3 million if you had invested it in the S&P 500 over time. That money would have compounded to over $1.3 million. That is a nice nest egg. That's a good looking nest egg, especially considering that you didn't invest that much money. And if you are to buy these indexes, the S&P 500 being the one that I'm focusing on right now, that means that you are, like I was saying earlier, since they self-select into firms that are meeting their qualifications, you're buying winners. You're buying companies that are doing well over the long term and that do grow to an adequate size over time. And that can be very good for your portfolio. That's very good for long-term wealth building, as we just saw. And then if I haven't convinced you just yet, let me ask you this. Do you own a home? Do you constantly check what the value of your home is worth? Do you constantly go and get your home appraised time and time again? No, you don't. You tried to buy a home in a good neighborhood with, big old oak trees and, homes with good foundations, or maybe it was a new home or whatever it may be. You didn't care, or you didn't ask, or you didn't make a big deal about the fact that the value of your home could decrease over the course of a year. And if the value of your home were to decrease, would you just go and sell it? Well, of course not. You wouldn't just go and sell your home. Why? Because it's an investment you've made. It's something that you and your family need. Well, you and your family also need your investments for the future. So why would you just go and sell when a stock market index drops, and typically drops more than it should? There was an overreaction or something like that. Why would you go and do that? That is counterintuitive. If you wouldn't do it with your home, why would you do it with a stock? I'll tell you why. It's too easy. It's too easy to just make those illogical decisions. And like I said, a lot of people don't have the knowledge and the comfortability with their market investments in order to weather the storm when the market does fall. And so they end up selling and end up losing their heads, and that's the danger of all of it. But it all comes from the knowledge. It comes from understanding what's going on. It comes from being able to rationalize what the market is actually saying. And you don't have to be a whiz to understand this. Are companies going to increase in value over the long term? Yes. If the American economy stays around, then the American companies in these indexes are going to increase in value over time. And guess what? If you don't believe in the American economy, there are indexes for the world economy and indexes for the European and the Asian markets, all these types of things. You can buy a group of companies that will go up over time. It's just common sense. And then the last way that I'm going to try to bring you to my side as to why you should trust the stock market, it makes millionaires. It does. And I'm not talking about Warren Buffett, and I'm not talking about Jeff Bezos and Bill Gates and all of these guys and Elon Musk. I'm not talking about these individuals. Who I'm talking about is people just like you and me. It makes millionaires. People who their net worth is greater than or equal to $1 million. And these millionaires are putting money away over time into retirement accounts or brokerage accounts or whatever it may be. And they're doing so systematically and building their money, compounding their money over time. And they're making themselves millionaires just by buying big diversified groups of companies in the stock market.